Did Warren Buffett ever draw lines on a chart, or has he always been this perfect investor with 20% annual rate of return? That's what we will find out today in Investing Mastermind Podcast. My name is Sina Lundholt.
And I'm Michelle Markey.
Today, we'll talk about Warren Buffett and the whole timeline of how he started investing, what happened, who actually impacted the way he invests. And we'll start talking about what he invested in as a very young investor and how he actually went about the whole stock market trading game as a very young man, what actually happened when he changed his mind and completely changed his strategy. And then even later in his life, once again, he made a pivot and change his strategy again. So basically, the way Warren Buffett went about it back then was, he put some money into a stock that he thought would be going up. So he was just looking at the stock charts. And when he was a young man, he actually looked at the stock charts. Is the stock going up? And if the stock was going up, that's how he would go about it. He's been mentioning that in, for example, some of the Berkshire Hathaway annual meetings where he talked about how he would invest as a young man. So, Michelle, have you ever done that? Followed that strategy of looking at the stock chart and trying to predict this stock will go up in the future because on the stock chart, it looks like it's going up?
Yeah, I think early on when I was younger, I tried looking at just patterns on the chart and seeing where it would go, and it didn't really work out. And there's all kinds of patterns people might try to do in some technical analysis where it's like a heads and shoulders pattern, and there are all kinds of patterns out there that are kind of just nonsense. So I quickly realized that I shouldn't be heeding this stuff because it's like tarot card reading. Like it's trying to figure out your stock market fortune and things that may not be relevant. And also, just because a company performed a certain way in the past is no guarantee of its future performance. So even though a lot of what we look at when we're studying investing is we're looking at the historical performance according to the annual investor relations documents like the 10K or the quarterly filing called the 10Q. But those are not forward looking. They can't predict what exactly is going to happen, but you have to look at some of these things as clues as to what maybe could happen. Because I think there's a Warren Buffett quote saying something like, if all you had to be is a librarian, you would be a millionaire in the stock market or something like that. It's interesting that just because you're good at knowing history doesn't mean that you're good at knowing how to invest. So you have to sort of draw a different conclusion from what we might learn about. And Warren Buffett clearly drew different conclusions as he learned more about investing. So he had a certain investing style between the ages of, say, 11 to 20 or so. By the time he was in his master's program at Columbia University and he got the professor and mentor, Benjamin Graham, that totally set him on a new path of investing.
Yeah, and I think it was maybe last year or the year before at the annual meeting, he did say that, when he was young, like in his early 20s, he did use technical indicators, which, it could be Bollinger Bands or it could be stochastics or any other technical indicator. There's so many out there, just like with the drawing head and shoulders and things like that. As Michelle mentioned, there's also technical indicators. And he was doing that as a 20-year-old. And well, he thought that that was the way to do it. But then he read the book by Benjamin Graham, which became his teacher and later mentor. But he read the book Security Analysis. And what he said was that then everything just clicked for him. He totally understood what the whole stock market was about, was what investing was about. So he dropped all the charts, all the technical indicators, everything he was doing, and just 100% focused on Benjamin Graham's investing style, which is called value investing. So he became a value investor. And as you mentioned, Michelle, he started at Columbia Business School because that was where Benjamin Graham was teaching, and he really wanted to go to that school and learn from the best.
Yeah, and when he learned that style of investing, it was called cigar butt investing, where Benjamin Graham would invest in companies that almost were at the end of their life, that in a way of cigar butt, you're expecting to just get one puff out of them. So you expect to get one puff of cash left out of these companies as they were headed down and maybe about to be liquidated. So for a while, that was influencing how Buffett invested throughout his 20s, and it's partially why he went after some companies that he would consider a bit of a mistake now, including Berkshire Hathaway when it was still a textile mill back in the day. And then Warren Buffett evolved in his investing style when he met Charlie Munger at the age of 29, and Charlie Munger was like 35. And Charlie Munger helped Warren Buffett see beyond only doing cigar butt investing, because while it can be successful, Charlie Munger said it can only be done to a limited scale, and you have to be willing to invest in wonderful businesses at fair prices, not fair businesses at wonderful prices. So he flipped some of the Benjamin Graham mentality on its head. And even though Charlie Munger stays respectful, but the way that Charlie Munger invested was very different from how Benjamin Graham invested. And that fundamentally changed how Warren Buffett would invest in the future.
Yeah, because also Benjamin Graham, he was investing at a time where the world didn't do well. There's been world wars, there's been depression. So you could actually snap up some good stocks at a quality or not quality, like cigar butts. You could buy any kind of stock at a very, very low price. And that's something that you typically see when there's like wars and depression. John Templeton, who's also a very known investor, also bought a lot of stocks that was trading at a very, very low price. And then some of them would go up and some of them wouldn't. So when it's times of trouble, then you could potentially use the value investing method. And I also think for Buffett, what he mentioned about Berkshire Hathaway and buying into that stock was he actually started caring about the company, he started caring about the employees. He learned the stories of Portuguese workmen who came to the United States and work hard at some of the mills. So for him, he just couldn't just close Berkshire Hathaway. Like his plan was to just get it over with and end it, but then he just couldn't have himself doing it. And maybe that was part of why he was listening to Charlie Munger was maybe also, that guilt. It took some time for him from when Charlie Munger first shared that idea. It took some years, if not a decade, before Buffett actually was like, yeah, maybe it's not a bad idea, and actually made a pivot and bought his first company where he used Charlie's method. So yeah, would you call it value investing, what Buffett is doing today, Michelle?
Not especially. I know he's often considered a value investor by the media, but according to Warren Buffett and Charlie Munger, they like to think of what they do as just investing mostly, or as you reminded me, Charlie Munger might consider it focus investing, but value investing is not quite the best term for it per se, because what Charlie Munger has said is that all investing is value investing. The value you get is what you pay for, sort of thing. And if we try to think about that and sort of dissociate what commonly is thought of as value investing, like in a lot of Wall Street, they might say there's a lot of value stocks, and that can get confusing of pitting a value stock against a growth stock. So you would think, oh, Warren Buffett is a value stock guy. He likes buying stocks when they're cheap or something like that. But that's not really the case. In fact, Warren Buffett has often bought some growth stocks like Apple, and that's kind of opposite of what you would think. Here we would think, oh, Warren Buffett is such a value investor, and yet he's bought plenty of growth stocks. So some people also like to consider it, say, growth at a reasonable price, or GARP. So that's another sort of acronym out there of a way to approach maybe investing of what is a reasonable price for a growth company. That's not necessarily something that is always tagged to Warren Buffett, but he kind of just does investing wherever it makes sense. Sometimes he takes advantage of arbitrage opportunities or currency arbitrage opportunities, or even sometimes derivatives or stock options. So that's not usually what you would consider a value investor to be involved with. So Warren Buffett has many facets of how he invests. he is not only what the media often calls him as a value investor.
I had almost forgotten about GARP. That's right. I remember that one. But yeah, when we started the podcast, we actually did talk a lot about should we call the podcast. And this is also where you mentioned to me, I don't think we should mention anything about value investing because that's actually not what he is doing. And I thought, you are so right. He is not a value investor anymore. I mean, it's been a growth journey for Warren Buffett, and it's like the perfect growth he's been through, right? At learning how to buy companies cheap from Benjamin Graham and then getting that aspect of, okay, but you also need the quality aspect. Why buy things that are cheap only instead of buying quality at a discount? And what we've seen in recent years is we haven't seen depressions or wars for that as long as they did in the 1920s, 30s, 40s, where Benjamin Graham was an investor. So this is actually, it's been a great time to pivot and do that type of investing that Munger brought forward, where you want to pay a fair price for a wonderful company, not pay a wonderful price for a fair company. So I definitely think that Buffett evolved and that his technique today, yeah, it's not value investing. Could we in the future experience a period where value investing would be interesting to use again? Well, we don't know. It really depends on what's will happen in world history, but potentially, we would maybe go into an environment where you could use some of the ideas from Benjamin Graham's value investing strategies of buying cheap companies at a cheap price. But even regardless, I think, the idea about buying quality is key here. Buying a quality business when that business is maybe going through a tough time. Maybe it's just what we've seen also is that the CEO says something controversial and then the stock price falls, or something controversial happens that will make the stock price fall. And the next day, everybody forgot about it and the price will go back up again. And that's where we'll be able to actually scoop up some of those quality businesses at a fair price, and then maybe not be as scared of price as Benjamin Graham was. Benjamin Graham, with the history he had, I totally understand what he went through. If you want to know more about Benjamin Graham's history, you should definitely go back and listen to the episodes where we talked to Charlotte Janice about her grandfather, who was Benjamin Graham, and his history, where, yeah, it's very evident why he started this investment style and started this movement that today is investing. We can just call it investing.
Yeah. And interestingly, one of the differences in Warren Buffett's style as well, compared to what Ben Graham did, Ben Graham would invest in hundreds of companies. And it's very different that Charlie Munger said, invest in only a few companies that you are capable of understanding. So I think Buffett was highly influenced by that. Instead of investing in hundreds, to really think carefully about the very few. And one of the ideas Warren Buffett had is, imagine you have a punch card with only 20 punches, that in your entire life you could only buy a total of 20 companies. You would think a lot more carefully about which companies you can buy, and you punch a hole in that ticket every time you buy a company. So if we think about it like that, that's exactly the principle that Charlie Munger lived through, and we saw in the company that he was a chairman for many years, Daily Journal Corporation. You could see they only had 4 publicly traded companies in their portfolio. And interestingly now, as of early April, the 13F equity holding filing just came out for Daily Journal. And we can see that they're somewhat changing a little bit from what maybe Charlie Munger's investing style was, where Charlie Munger would invest in companies forever. And yet now, Daily Journal, with new leadership, has been reducing in all of the 4 stocks in its portfolio. So I find that very different than the Charlie Munger style of investing, that now that he's no longer on this earth, I guess the leadership has a different mindset about investing. They're no longer wanting to hold on to these stocks forever. They want to maybe cash in some of the profits or do tax loss harvesting with one of them that probably they have a loss on. And yet I find that interesting, that didn't Charlie Munger teach them anything? Why did they decide to start selling off these stocks, even though they still have a good portion of them, but ever so slightly they're winding down on the Charlie Munger philosophy? And I feel like that's unfortunate that daily journal is not sticking to what seems like Charlie Munger's investing principles.
Yeah, that's really interesting information, Michelle. I hadn't seen that. I haven't seen that they have actually been selling stocks. And I remember that Charlie, he talked about a lot about his legacy at the last meeting, and people were asking him specifically about it. So that's why he was answering those questions, and that he definitely hoped that generations to come would be more thoughtful about how they invested, even though that's not what he was seeing. So he always had a fun comment. But yeah, so what we can say is that Buffett ended up with the strategy today. He's been through it all. He's been through the just buying, looking at charts to see if the stock price went up. He's been using technical indicators and technical analysis on stocks. And then he made a pivot and did value investing for a while until Charlie Munger introduced him to the investment style that he's still using to this day, and that he's used to not only buy stocks, but many other things like properties, and getting a lot of investment opportunities out there with that mindset. So with that, we're coming to an end of today's episode. Do you have any closing remarks, Michelle?
Yeah, the one last thing I want to mention is you might have listened to our podcast and looked at what are the equity holdings of Berkshire Hathaway and seen, oh, but they own a lot of stocks and have a lot of companies. And that may be true, but also remember Berkshire Hathaway is huge and there's only so many companies that can move the needle for them. So while Berkshire Hathaway isn't only invested in 4 companies, they are trying to still be very mindful about the few companies they are invested in. So at least it's not hundreds of companies like a lot of people are in their mutual funds or ETFs. It's still probably less than 100 in total between their owned companies and the stocks they own. So just keep that in mind, is that I think even though Berkshire Hathaway is more diversified, they're still trying to stay true, I think, in large part to what Charlie Munger taught them. So keep that in mind. If you're wondering, should I diversify a lot or rein it in? And I think the better way to go is the way Charlie Munger would have told us to do it, is try to be very mindful about the few companies you choose to invest in. And I think you'll probably end up pretty well off in the future. So that's what I want to just throw in there as well.
Well, that's a perfect way to end the show. And we'll be back in a week from now on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.